If you are struggling to see buy and sell signals on candlestick charts, this episode is for you. I know what it's like to pull up a candlestick chart and say to yourself, I don't see anything. I can't tell what's going on. I see a lot of shapes. I see a lot of lines. I know other people are using these charts to make money. A lot of people are using these charts to help them get in before a big move or get out just before a flush. And yet I feel like I'm always one step behind. I don't get it. And here's what I'll tell you. Learning how to read candlestick charts takes time. It is a lot like learning a new language. Each of these candlestick shapes, when we decode them, they communicate meaning, different sentiment about the market, whether bullish or bearish. And when we combine multiple candlesticks together, they send very clear buy and sell signals that more sophisticated traders and investors are seeing and utilizing in their trading. I'm going to share with you 10 specific tricks that you can implement in your trading starting today that's going to help make reading candlestick charts easier. Now I've got the whiteboard, we've got the screen share, and let's go ahead and jump in with the first trick. The first trick is to not trade during sideways consolidation. This is such a big mistake that a lot of beginner traders make. So essentially what happens is, if we jump onto the whiteboard, what a lot of beginner traders do is they'll see something moving up very quickly. So just imagine these are candlestick charts. It's a candlestick, so it's moving up very, very quickly, surging higher, and then all of a sudden it starts to pull back. And so after it's made this big move, you now see it. It comes up on your scanners. Maybe you saw people talking about it on social media or whatever the case is. And so this is where you start focusing on it. But guess what? Now at this point, what's it doing? It's more or less going sideways. So although it's true that even sideways price action, there will be some ups and downs, this is not the area where big money is made. So I'm gonna let you in on a little secret. Candlestick charts work really well, most of the time. But there are times when in fact, they're borderline useless. And this is a problem that beginner traders often don't understand. If you trade using a candlestick chart during the time when they're not effective, you're not gonna see good results. In fact, you're most likely to lose money. So what's a time when a candlestick chart will be less effective? Well, it's during sideways consolidation. Now, if you've watched one of my full-length episodes where I decode the individual candlestick shapes, all of them that make up our candlestick charts, you'll know that these candlestick shapes are communicating sentiment in the market. And so the areas that I get the most interested is when stocks are about to change directions. So when we get a big move to the upside, and we'll just go back here. When we get a big move to the upside, let's just say we get a nice big squeeze to the upside, and then right at the top we have a candle like that. That's a candle I pay really close attention to. Then we have a little bit of a pullback here, and then we have a candle like this. That's a candle I pay close attention to. And then we have this next wave higher, and let's say it goes all the way up to here. So these are areas where I'm paying extra close attention. These candles are indicating a change in trend, and changes in trends are areas where we're going to focus. That's where we're going to sell, and this is where we buy back. This is where we're going to sell, and then down here, after another one of these, and it can be red or green, this is where we're going to buy back for the next leg up. So these are areas that we're paying really close attention. So when we're talking about candlestick charts, and we're talking about the individual candlestick shapes, it's important that what we're looking at, the instrument we're looking at, is actually moving. Because if it's going sideways by default tells us the sentiment, that the sentiment is indifferent. There's a battle between the buyers and sellers, or maybe not even much of a battle. There's just not a lot of buyers and sellers, period. So the price is just kind of going sideways. So let's look at an actual candlestick chart right here. This is a candlestick chart. This is a 1-minute chart. And this is on an instrument that, we'll do 5-minute chart here. This is on an instrument that more or less is going, as you can see, sideways, right? Let's big picture. This is going sideways. How can you tell it's going sideways? It's not going up, it's not going down. And the moving averages are more or less flat. So in a moment, I'll talk about the technical indicators I use, but when you're looking at the moving averages and they're more or less flat, that's a big picture way of understanding the price is going sideways. So when the price is going sideways, what does a candle of indecision mean when the price is already indecisive and it's going sideways? It means nothing. What does a potential reversal candle mean when the price is going sideways? It means nothing. There's no significance. So when the price is going sideways, candlestick charts are not as accurate. In fact, there's not a chart that's more accurate. It's just simply the fact that when the price is going sideways, there's really nothing to trade. But what a lot of beginner traders make the mistake of doing is they'll see something that's making a big move up, so they get focused on it, and then they start trading it sort of after the big move has already occurred. So they're late to the game. They're late to the party. They're over trading what I would say is that sideways period of consolidation. And I don't want to trade the sideways period. I want to trade when the price is moving up very quickly. So let me show you another example. We'll jump on, we'll actually look at this same chart, but we'll go back a couple days. So if we go back a couple days, this is an area here where on this day, trading this stock right here, I made about $55,000. Now, everything I'm sharing with you, you could apply equally to Forex, to futures, large cap, small cap. You could apply it to cryptocurrency. The language of the financial market and candlestick charts is universal to different markets. I happen to choose to trade the stock market for a number of reasons. I really like it, but you could choose to trade something else if you wanted. But nonetheless, right here, what you have is a nice move up and then a little bit of sideways consolidation. So during the move up, that's when I want to be trading it. Now, during this sideways consolidation, what are the moving averages doing? They're still sloped pretty firmly up. So this is a technical pattern that we would call a bull flag. You've got a quick move up, you get a little bit of sideways consolidation, and then that usually leads to another leg higher. So what I want to be doing is trading the legs up right here, and then avoiding over trading while it's sideways and waiting for the next breakout to the upside. Trading the upside, avoiding over trading when it's going sideways and focus on the upside. And then in this area here, this is not worth trading. This is more or less sideways. Now we're starting to flatten out on our moving averages. The price is broken down a little bit. This is an area where I'm sure a lot of traders gave back profit. Although you do see this one kind of last final push up here, it was sort of a sudden push and then another reversal, which only kind of reaffirmed that you're in a very choppy consolidation area right here. It sort of pops up for a second, and that's not really worth trading. So look at your moving averages. Ask yourself, are they flat or are they sloped? And if they're sloped, then that's the area we want to be paying attention to the pullbacks. But if they're going sideways, and certainly if they're going down, this is not an area where, well, if they're going down, then it's trending down and you could trade this to the short side. But for me, focusing primarily on trading the long side, I'm not going to trade when the price action is sideways. So when the price action is sideways and the moving averages are going sideways, I'm going to leave this alone. That's trick number one. Don't trade sideways price action. Trick number two, print out your favorite chart patterns. This is so important because here's the thing that we're doing as traders. We're making a prediction of what's going to happen next. So when we're looking at this chart right here, just to zoom in on this one again, you see that we had this nice squeeze up right here. We had this nice rally up, a little bit of a pullback, and then a push higher. This is the traditional bull flag pattern that I absolutely love trading. And so in the moment when this pattern was forming, we had to be able to make a prediction of what was going to happen next. So this is what we had to work with, right? The price had squeezed up, then it pulled back, then it pulled back, then it pulled back. So there are a lot of beginner traders that look at this and they're like, I don't know what to do. So here's what I would suggest. I'm going to just erase this here real quick. So we've got this pattern here, usually 2-3 candles up, and then usually it's 2 to 3 candles down. And then we're looking for another 2 to 3 candles back up. So this is the pattern that you want to print out. Now, typically this catches support right around your 9 EMA, which is the exponential moving average. So that's a level of support right there. So if you print out this pattern, you have it printed out, you have it taped next to your monitor. Then when you're seeing this in real time, you've got your reference of what this looks like when it works the right way. And for me, that was super helpful in giving me the confidence and conviction to go ahead and start taking some of these trades. I just felt like by seeing the pattern, how it resolves, it made it so I could visualize what was going to happen better. So I would really encourage you to print out examples of your favorite chart patterns. That way you can see it. And as it's starting to form, you'll have the conviction to, okay, I'm going to take a starter. Now, it doesn't mean you're going to take 100,000 shares of it and put your life savings into it, but just that, all right, I'm confident enough that I'm going to throw a couple hundred shares at this or whatever it is in a simulator, take a little bit of a position and see if I'm right. Now with a pattern like this, our stop is the low of the pullback and our profit target is a break through the high. And so this worked out really well as it went from 6 all the way up to 850. Now it actually went higher, went all the way up to 11 right there, pulled back again, and then we got another push higher up to 12. So what I'm going to do for you guys to make it easy, I'm going to give you a PDF. It'll be linked in the top of the comments, and so I'll pin it to the top comment, and I'll also link it in the description where you can download my 112-page technical analysis PDF, and it has examples of all of my favorite chart patterns. You don't have to print them all out, but you could choose to print out the ones that you like the best. Now, this is my favorite pattern, this first and second pullback pattern. The reason that I like this pattern is because it's easy to find and it usually resolves well. So how do I find this pattern? Well, in this moment right here, I find it as the price is squeezing up, because as the price is squeezing up, this is going to be hitting what? My scanners. It's going to be hitting my high of day momentum scanners. So these are the tools that I'm using right here. So when a stock starts moving up, these scanners are searching the market in real time. So I get the audio notification, boom, scanners, here's the stock on the scanner, take a look. I pull up the chart, I see it's moving higher, and now all I have to do is patiently wait for that first pullback, wait for that pattern to form, and then take my trade. So it's easy to find, and that this is really the first way to get into something that's strong, is by buying the first pullback. There are some more complex patterns that you can trade, but they usually take more time to form, and the best setups don't wait. They just squeeze and go right away. So even if you got good just at trading this one pattern right here, you made this like the one pattern I'm going to memorize, I'm going to get really good at it. And even if you only took a few trades a week, 5, 10 trades a week, trading this pattern is giving me about 76% accuracy. Now that's me with a lot of experience and intuition, which helps guide me of when I should trade it and when I should not, because there's other external factors like what was the news on this stock that was allowing it to go so high? What did the daily chart look like? Was there a nearby area of resistance? So there's a checklist that I kind of have to go through to understand the full potential that this pattern can give me. But understanding the pattern is sort of the foundation. Understand the pattern, understand what it looks like when it resolves the right way. And then some of the other things that we're going to have to review, we're going to continue to talk about in today's episode. So we're going to keep going. Trick number 3, ask yourself, why does technical analysis work? By answering that question, you're going to have a better sense of what you should be focusing on any given day. So the reason technical analysis works, the reason these first pullbacks get bought up, as it did right here and as it did on this chart, is because there are so many traders in the market that are looking to profit from volatility. And so when you have, whether it's a stock, a cryptocurrency, a Forex pair, a futures contract that has some type of news, there's some type of catalyst that's creating the momentum behind it, traders are going to look to ride that trend. This is what's called momentum trading. You look for something that's moving and you look to jump on and ride that wave of momentum as long as you can. So essentially, the way I think of these stocks is they're kind of like trains they leave the station, every few hours there's another train that leaves the station. And I don't want to try to just guess which train is going to leave the station. When I see a train starting to move, I want to jump on it. So that's really important. What do we need to see? We need to see already initial signs of movement. And in fact, if we really want to see a big move, then in the context of the market, it has to be one of the most obvious stocks in the entire market today. So if we pull up our charts here, UPXI on this day ended up squeezing all the way up over 900% in a single day. It was our leading percentage gainer in the entire market. So therefore, it was obvious. Because it was obvious, there were thousands, tens of thousands, hundreds of thousands of traders that were watching these candlestick charts. And so when all of a sudden the charts start to pop up, there's a lot of short sellers that are in it that are covering. There's a lot of long traders that are buying. In other words, the patterns resolve more predictably because they become a bit of a self-fulfilling prophecy. They work because we expect them to work. I suppose like traffic signals. A red light means stop, and everyone understands that, respects it, and therefore people stop, with the exception of, some idiot that's going to blow through. But the majority of people are going to stop when they see that red light. And so candlestick charts are kind of similar. They're giving us red light and green light. They're saying stop. The current price action is in sideways consolidation. We don't want to trade it. The moving averages are flattening. Don't touch it. And then all of a sudden, we start to pull away. First candle is making a new high. That's a pattern that I focus on a lot. This setup right here, first candle making new high, when that green candle makes the new high versus the red candle, that's where we're changing directions. So that's the place where I'm a buyer, all right? So all of a sudden, that's the green light. And everyone's like, green light. We've got a leading percentage gainer in the entire market that everyone's looking at because the stock has great news. And now you've got a green light on it. What do you expect is going to happen? You're going to get good resolution. The price goes up. Anyone who's thinking about shorting it, they're waiting. They're not going to short right into a green light. That's like crossing the street when everyone's driving. You're not going to do it. It would be, if you did it, you would just lose money. It wouldn't make sense. And so the market sort of follows these rules. But if you try to apply these rules of technical analysis to a stock not moving, well, you're going to have a problem. So this UPXI is a perfect example because on this day here, it was fantastic. I did great on it. And if I tried to trade it today, I would be red because it's not moving. Today, there is nothing to trade. Today, it doesn't have news. Today, it is not the obvious stock. So technical analysis works on the obvious stocks each day. That's where it works the best. So you have to ask yourself, am I trading the most obvious stocks? Now, in the description where I've got the link where you can download my 112-page technical analysis PDF, on that same link, on that page, you can also download my stock selection criteria. I've got my 5 pillars of stock selection. Those break down my 5 criteria that I've set out for a stock to be what I would consider obvious. And if it's not obvious, I'm not going to trade. Now, I'm someone who I trade pretty much every single day, but periodically there'll be a day where I have no trades. And it's because on that particular day, there was not a single stock that really met all 5 pillars of stock selection. And so it's easy for me to say, no, I'm not going to take any trade because I know exactly what I make money on. So if I don't see that, well, then of course I just don't trade. Now, the good news is there are so many stocks in the market that I see opportunities pretty much every day. And this is true in other markets too, certainly in cryptocurrency markets where you've got an infinite supply of different cryptocurrencies that are moving every single day. Okay, so why does technical analysis work? It works because it's a respected language that other people are using as well. Therefore, focus on the stock that is obvious. Trick number 4, remember your reversal candles. Okay, so if you've watched my full-length episode on decoding those individual candlestick shapes, you know how important reversal candles are. So if we jump back over onto the whiteboard here, we'll just, I'll draw out this chart for you again. So we're gonna have the price squeezing up, and typically after a quick rally up, and this could be going up 30% or 50% in 5-6 minutes, usually you get a correction. And so let me just give you a scenario. Let me just help you imagine this. So let's just start where this is the first candle. This is the second candle. This is the third candle. That's the fourth candle. What are the shapes of these candles telling us? Especially when the volume is increasing, the candles are getting bigger, volume is increasing, sentiment is getting really strong. But what often happens when you get a big extension like this is that eventually you get a battle at the top, where suddenly buyers are realizing this stock is extremely extended off of its 9 moving average, 9 EMA. This is support. So we're really far away from support. So long traders start getting a little nervous adding this high. Short sellers start thinking, this is pretty extended. If we see even the slightest sign of weakness, I'm going to take a short position. And so all of a sudden you see this candle right here. What is this candle shape telling us? The language of the financial markets, technical analysis, and candlestick charts, this candlestick is a doji. It opens and closes at the same price, and it has a little upper candle wick and a little lower candle wick. This is a candle of indecision. This was very decisive price action, now followed by indecision. What's going to happen likely is a short-term, at least, correction, where the price begins to drop back down. So remember your reversal candles. what are some other candlestick shapes that we might see up there? So one, and we'll just kind of, I'll just reversal candles. So we're going to start with the doji. Now, and I'm going to make this candle a little bit smaller just so we can have more room to draw these out. That was the doji. This right here is a different form of doji called a gravestone doji. A gravestone doji has this longer upper candle wick right here, and this is even worse than this standard doji here because it shows that the price didn't drop down and buyers brought it back up. You didn't get that. All you got essentially was the price squeezing up and then sellers pushing it back down. And remember, when it comes to candlesticks open approximately where the last one closed. So closes and then opens. So closes, the next one opens here, which means the second it drops even just a penny, you've got a red candle. So a gravestone doji indicates the reversal is already beginning. This is a bearish candle. Now here's another one that's pretty bearish. We open here, we get this topping tail, we come down, and then we actually close slightly red. That is called a shooting star. But context is very important. These are important candles when they occur in this position right here. So this is position 1, 2, 3, 4, 5 of this pattern. You have short body candle, medium, long body candle. And in this fifth position here, when you have any reversal candle, it indicates a very high likelihood that we'll get a short-term correction. Now, if we were talking about a chart where the price was going sideways, then the shooting star candle is not really of any consequence. No one really cares about seeing a shooting star candle when the price is already going sideways, because going sideways already communicates that there's indecision. So it's only in the context of this big move up or a big move down that these reversal candles gain their significance. So the shooting star candle here, the gravestone doji, and the standard doji are the ones that I pay the closest attention to. Now, it's possible that this candle could be green. So we could open, we could close green, but we have a topping tail. It's still a shooting star. It's not as bad as if the candle's red. The next candle is going to open here. And if it goes red, it has to drop a little bit before making the first candle to make a new high. So then I guess I would say the second pattern, these are individual reversal candles, and green is still valid as well. And then this is a 2-candle pattern here where, well, actually I'll do it a little differently. The 2-candle pattern is where you've got candle 1 and then candle 2. And we call this candle under candle. So you've got a candle and then the next one goes underneath it. So those are your first, and then this is your basically confirmation. So this right here is, I'll put an exclamation point. That's a warning sign. So we'll do it in orange, make it really official. All right, so these are warning sign candles. And then this is your basically confirmed reversal candle right here. This means get out. So now you've got your confirmed reversal. Okay, so pay attention to those reversal candles and be looking for them, because those are the candles that are going to give you that edge. So remember at the beginning of this episode, I said, do you ever feel like you're seeing other people who are getting out just before the drop? How do they do that? What are they seeing? How do they seem to know the drop is about to come? It's because they're paying attention to these reversal candles. These reversal candles are the precursor to the drop. So you get the drop, but it's the reversal candle that first gives you that signal that the trend is beginning to get exhausted. Now, that's your reversal indicator to the upside. But then we drop back down right here, and then let's say after 2 candles of pullback, we get a candle like this with a bottoming tail. Now, all of a sudden, that's the inverse of this shooting star right here. We call that candle a hammer. It's hammering out the base. This level here, the low, is the base. That's support. And this is a place where I'd typically be a buyer for candle over candle. So these are reversal candles going down. But this would be after a candle going down, you get the next candle going back up right here. And it can be red or it can be green, but it's the candle over candle. So now all of a sudden you've got the reversal going the other way. And maybe to make this a little bit, so these are reversal candles. So we'll just call this top reversal candles. And now we'll switch over to this side and do bottom reversal candles. So the bottom reversal candles, you've got the squeeze that went up right here, and then we had the pullback right here. So let's just do a shooting star, pullback, and then what different candlestick shapes here could we have? That's called a dragonfly doji. It's a doji. This would be just a standard doji, like that. All right, so this is the same doji that we had before. This is the inverse of the gravestone doji. It's called a dragonfly doji. Then we have a hammer candle right there, the hammer candle. And then we have, these are our caution. We may be about to see a reversal. Oops, what happened there? All right, so caution. We may be about to see a reversal. And then this one here is going to be going back up, confirming the reversal. And that's going to be when you have a red candle, and then the next candle makes a new high. That's a 2-candle pattern. So one red candle, next candle makes a new high, and then that's where we're looking for that move back up. So I want you to pay extra close attention to these areas. So anytime you're looking at a chart, look at these candles up here that mark the tops and the bottoms. And now, just for the sake of it, let's go ahead and pull up some charts and look at some of these reversal points. So let's see. So we've got UPXI here. So we'll just do this. This is fine. So on this one here, you've got a topping tail. That's often indicative of a potential reversal. Another topping tail here, indicative of a potential reversal right there. Now this one, if we get zoomed in here, 1, 2, 3, 4, 5 candles in a row that are green. All right, now that little bit of a topping tail, but it pushes higher. So we finally here get a red candle that closes. The next candle goes lower. And then what do we have at the bottom? A doji, right? That's the doji candle, and it pushes higher. Now you do have a doji right here, but you don't get the next candle making a new low. So this is the caution sign of a potential reversal, and the next candle breaking the new high is the confirmation. So if you jump in before confirmation, you do run the risk of it ends up confirmation never actually occurs and you got in or got out too early. However, if you're in a position and it's been making a really big move and you're up quite a bit, then it's often not a bad idea to consider taking profit when you get that warning sign candle like this, because the swing back down can be so dramatic. So that is a shooting star. We've got our big topping tail there. So if you had waited to sell down here, you would have missed out on getting out up higher. So now I'm going to share with you trick number 5. Trick number 5, and this is a really important one. Watch the clock. All right, so let's look at this candle right here. So this is a candle that is, as you can see, a large topping tail, shooting star. But it's a 5-minute candle, which means this candle had 5 minutes to form. Okay, so over the course of 5 minutes, this candle, the price squeezed up and then it came back down. So what I often do is I look at the clock down here. So right here it says 11:04 and 25, 26, 27, 28, 29, 30. So what do I know? This 5-minute candle is going to close in about 25 seconds. Now, if this 5-minute candle still had 4 minutes left on it, let's just say this was actually like real time, then the shape of the candle would still be actively changing based on the price action because the candle is still open. So I really pay close attention to the last minute or so of a candle, if it's a 5-minute candle, the last few seconds of a 1-minute candle, because once that time goes, 11:05, that candle becomes solid. That's now a part of history. That candle will not change ever again, and a new candle opens. So watch your clock. What a lot of traders get good at is they see the pattern starting to form. They see, for instance, on a pullback that it's basing out, and then they have maybe a little bottoming tail, and then they notice, oh, there's only 10 seconds left on this current candle. The next candle that opens, if it breaks this price right here, we've got confirmation. So I'm potentially 10 seconds away from getting confirmation. And so now that time factor helps the decision of going ahead and taking the trade because you know that this candle is about to close as that reversal warning candle that you were thinking it would. Whereas if you got in too soon and the candle still has a lot of time left, the shape could change significantly. So this is an example right here that's, you could see the candle is actively forming. Now this isn't moving super actively, so the candle's not, it'll change shape just as quickly as orders go through the market. But you can see it changes a little bit, just went to red. So one of the things that is important to know is that focus on the clock based on the time frame you're trading on. So if you're trading on a 1 minute time frame, make sure you're synced up with the current time of when this 1 minute candle is going to close. They always are going to close at the top of the hour, or at the top of the minute. So every minute they close, exactly starting first candle at 4 a.m. and then last candle at 8 p.m. for the stock market. So you know when the candles are closing, and so if a candle is currently a long body candle and it's very bullish and it's about to close, it's probably going to close bullish. Or if it's a doji, it's probably going to close as a doji. Or if it's a huge shooting star, it's probably going to close that way. And sometimes if the shooting star with a topping tail is dramatic enough, I don't even need to wait for that candle to close because it's almost impossible the price is going to be able to recover all the way back up, especially if I combine another indicator, which would be using level 2. If I'm using level 2 market data, then that in conjunction with candlestick charts can help reaffirm that this is not going to happen. Why? There's a huge seller right in the way. So the price will not go back up to the high unless magically there's a 100,000 share buy order that goes through and takes out that seller. But assuming that doesn't happen, this is going to close as a giant reversal candlestick. And sometimes an individual candlestick like that can effectively ruin the chart for the rest of the day. The chart just simply cannot recover from it. It's too big a rejection. In fact, yesterday we had an example that was pretty dramatic. This popped up right here, and you'll notice it popped up and you had this huge topping tail all the way to 350, and then the price came back down. And I was surprised it rallied back up even as much as it did, but it was very choppy, and I just kept thinking, how is this going to reclaim these levels here? This is such a bearish signal. So topping tails are bearish, bottoming tails are bullish. Why? A topping tail shows that the price moved higher and then the sellers were stronger and pounded it back down. A bottoming tail is bullish because it shows the sellers pushed it down and the buyers bought it back up and it ended up closing strong. So in the context of these charts, when we see a topping tail, especially when it's at the top of a move like this, it's an indicator of a reversal. When we see a bottoming tail after a little pullback, it's an indicator of a reversal, and this is something that would be buying. So we've got our top reversal candles, and we've got our bottom reversal candles, and we have to pay attention to the clock. Now, not only do we have to pay attention to the clock, but trick number six, we've got to pay attention to the time of day. So candlestick charts do not work well when we're in sideways consolidation. Now, sideways consolidation can occur at any time of day. However, for traders that focus on trading volatility, trading big moves, when big moves are most likely to occur? They're most likely to occur when a company is putting out fresh breaking news. When do companies typically put out breaking news? Most companies put out earnings either pre-market or after hours, and not during regular trading hours. So that means from 4 a.m. until 9:30 a.m. is the pre-market window where we're more likely to see a lot of volatility. Between 9:30 a.m. and 11 a.m., usually if you have something that was really strong from pre-market, it'll continue to be strong into those hours. And then after 11 a.m., volume dies down. And you have this sort of long stretch from 11 a.m., usually until about 3 p.m. where it's pretty quiet. Not much is moving. And then starting at 3 p.m., you only have 1 hour left on your daily charts. So now daily investors or traders who look at daily charts are now thinking this daily chart only has an hour left on it, the candle. It looks really bullish. I'm going to take a position. Or it looks like it's a reversal candle. I'm going to take a new position. So all of a sudden, from 3 to 4 p.m., you have this increase in volume as people are adjusting positions that they're going to hold overnight. So 3 to 4 p.m. is traditionally called power hour. And then what happens at 4 p.m.? The market closes, but after hours begins. And after hours is when more companies put out earnings news. So now suddenly after hours at 4 p.m., 4:30, 5 p.m., you can have a company that puts out news and boom, the stock makes a huge move. So if we broke down the best time of day to trade, the way I would say is we've got a couple windows. So the market, and this is for the stock market, so we've got 4 a.m. to 9:30 to 11 a.m. to 3 p.m. To 4 p.m. and then to 8 p.m. And actually, I should have spaced this out a little bit better. So I'll give you a little bit more space. So this is 8 p.m. at the end of the day. Let's see, 6 p.m., 4 p.m. So this is gonna be 9:30, 11, and then we had 3, and then this is gonna be, yeah. So this is sort of, if we were to track where the most opportunity is, it's usually gonna start around like 7. So about 7 a.m. here. Just make that a little bit better. So usually around 7. So we're gonna see a bit of volume, and then suddenly right at 7, more volume, and then 9:30, even more volume, and then it starts to kind of die down here. Dies down, and then can come back up a little bit here. And then all of a sudden you can get a little spike after hours, and then it starts to die down again. So this is the general window of where I find the most success trading. And actually the area where I really tend to focus myself is this window right here, because this is a nice, easy, 3-hour window where I can trade every single day. I can achieve pretty predictable consistency, and I don't have to sit in front of the computer all day long. This is a long window where I don't do well. And then coming back for 3 to 4 p.m., 3 to 5 p.m., I never do as well there because I don't want to take as much risk and give back everything I made between 7 a.m. and 11 a.m. So this usually for me doesn't work as well. And then of course, if you make a mistake, there's not much time to recover before the market's closed. So this is kind of the best time of day for me in my experience. And this is also going to be the time of day when the candlestick charts are the most reliable. Why? Because you have the most volume. You have the most liquidity. There's the most eyes on the market. So if you have a stock after hours that starts to pop up, but there's only 1,000 shares of volume, no one's really paying attention to it. No one's looking at it. 100,000 shares, 200,000 shares, the more it starts to go, the higher it goes, the more people will trade it, but there's just fewer eyes on the market. And this is true with currency markets too, that there's windows based on time zones that, this overlaps Asian markets and European markets and European markets and US markets. So you have these overlap periods where you're just gonna have more traders in the market. More traders means more volume, and more people who are seeing these very clear as day buy and sell signals are therefore reacting to them and trading based on them. So make sure you know what time of day it is. And if you're having a day where you're not performing particularly well, and you're coming to the end of the window when you typically would do well, you might be, well advised to say, I should probably walk away and call it a day. There's a book here that I'll share with you. This is The Power of Knowing When to Walk Away, Quit by Annie Duke. You could listen to it on audiobook. She's a professional poker player, and she talks about this great challenge when it comes to poker of knowing when to walk away each day. And you know what? It's true with trading too. We struggle with knowing when to walk away. Should I keep trading? Should I call it? And so I'll tell you that every day you're doing one of two things. You're either leaving money on the table or giving back profit. I would rather leave money on the table but walk away with profit in my pocket. And I know that from experience because I've done both. Now, typically for me, the way I trade, the way my P&L looks, is that on any given day, my P&L will look like this. So I'll start trading. This one's dead. So I'll start trading. I'll make some money. And then once I've given back usually about like 10% of my gains, that's when I say I'm going to walk away. Now, I could walk away here. I could walk away here. But I don't usually like to walk away till I've given back just a little off the top, because that way I know I kind of squeezed as much as I could out, and then I start seeing diminishing returns and some losses. So that's kind of the rule of thumb that works well for me. You could apply, based on your own experience, what might work well for you. But I think this is a good starting point. And so know the time of day. And if you're coming, to the end of your window and you haven't achieved what you want for the day, this is not the day to dig deep and trade longer. In fact, this is a day that you should walk away. But on a day when the market is really working for you and you've got 2 times your daily goal early in the morning, by all means, that's the day to be aggressive. Now, some would say, Ross, I thought as soon as you hit your daily goal, you just walk away. No. A daily goal is a reference point. But if I hit my daily goal in one trade, clearly the market is really hot. This is a day that I should dig deep and I should trade more. A daily goal for me is just based on, all right, over the course of the year, in order to make this amount of money, I need to average approximately this much per day. So I just use that as a rough, back of the napkin, rough daily goal. So my goal for this year, $5 million in day trading profits. That means I need to average $20,000 a day. So today I came up a little short on my daily goal. I'm sitting at $13,392. It's not bad. I'm not going to get bent out of shape over it. It's still a good day, but is it a day that I should push it and keep trading? Probably not. But last week on Monday when I was up 55,000, yeah, that was the day that I wanted to double down. The next day I made another 50,000. So it was like, wow, all right, clearly these are the markets where I'm going to dig deep and squeeze as much as I can out, knowing that there'll be other days where I make a little bit less and I have to be okay with that. Annie Duke has a great story about taxi drivers in New York City and how taxi drivers will rent the cab on a 12-hour shift. And she learned that when they rent their cab, they have to pay the lease for the 12 hours for the rent for the cab. They, of course, got to pay for gas and all that stuff. And so they have a goal of how much money they need to make in order to make that 12-hour shift worth it. And she said that statistically, that as soon as they make that number, they stop driving. And if they make it in 3 hours, then they're just bring the car back and they're done. But on a day that's slower, they'll drive the full 12 hours and sometimes even still not hit that number. And she learned that if they drove longer on the days they were picking up a lot of fares, they would make more money, even if it meant they stopped after just 3 hours on days when there weren't a lot of fares because people didn't need cabs. So that's an interesting lesson. And I think that definitely applies to trading as well. Dig deep when the market's hot, and when it's colder, slow down and take your foot off the brakes. Trick number 7, use pre-market data. Always make sure pre-market data is turned on your intraday charts. This is important because it will affect your technical indicators. So if you jump onto the charts here, I see this all the time because, of course, I trade quite a lot pre-market. So today's a day where I was trading STSS pre-market, and it's possible when I do my recap later that I'll say, this is where I traded it, and I had a nice exit up here at 760 or whatever. And someone will say, Ross, I'm looking at the chart, and I don't see what you're talking about. I don't see that it ever hit that level. And I say, well, wait a second. Are you sure that you have your pre-market data turned on? Because if their pre-market data is turned off, then they'll only see the day starting right here. So they'll never see that it went to that high level. And so see how these indicators are already coming down from that higher level? Well, they're including that data. So if you exclude pre-market, it's going to change the data input for all of your indicators, and it's going to leave you not seeing the full picture of what actually happened during the full trading session. So make sure you go into your settings and you always turn on pre-market data. Now, when it comes to daily charts, on daily charts by default are not including pre-market data. They include the price action from 9:30 a.m. until 4 p.m. There are some charts that do give you the ability to see what the pre-market highs and lows are, and that is valuable if you can. The only problem that I'll say is that when it's not uncommon for there to be very light volume during pre-market and potentially for the price to have squeezed way up and come back down, but on only like 30,000 shares of volume, which becomes almost like an anomaly, and therefore would be fairly safe to disregard that weird price action. However, on the other hand, there are times where you have really great volume pre-market and that pre-market data is relevant. So at the end of the day, it's probably a good idea if your charts are able to accommodate showing pre-market highs and lows on the daily chart to include it. If it's not, I wouldn't worry about it, but just something to keep in mind. So what I typically look at when I'm looking at a daily chart is I'm looking back and looking at the high volume days. These are the days with higher volume. So what happened on these days? The high volume days are important because those are the days where potentially you're going to have what are called bag holders. Now, I don't want any of you to become a bag holder. What's a bag holder? A bag holder is someone who takes a position on a day when the price is high, the price starts to drop, and they don't have the discipline to cut their losses. They keep holding, they keep hoping, they're just sitting and waiting and waiting and waiting. Next thing you know, the price drops more and more and more and more. A couple weeks later, they're still holding this darn position, And maybe they throw a sell order out to sell if it goes up 50%, let's just say. And so they're at work, they're doing something else. Usually bag holders aren't people who take trading super seriously, so they're only kind of half focused on it. So they throw out a sell order just to hopefully get out with a little bit of a smaller loss. And so then when the price starts to pop up, all these people who are bag holders from this particular day, they got in somewhere way up here. That's going to be potentially the resistance because they might start selling on that level. Now, that's especially true when that day is a red candle. It's not necessarily the case when it's a green candle, but definitely when it's a red candle. So UPXI here, this may now have some bag holders from this big day when it hit a high regular trading hours of $22 a share, right? Went all the way up to 22. And so, when it came back up here, I was thinking, well, geez, are you going to have some people that are stuck on this? And notice it came right basically to that level. It couldn't go higher. So if it comes back up again, it wouldn't surprise me if it continues to have resistance at that level and is not able to clear it. So include the pre-market data on your charts. It's going to make sure your indicators are working correctly, and you'll make sure you understand areas of potential resistance formed by previous spikes or drops. Secret number 8, fewer indicators is better. I'm ashamed to show this, but this is a chart that I used early in my trading career. There are more than 20 different technical indicators on this chart. It is unbelievably stupid. And I can say that now looking back. Why did I have this many? You can't even see the candlesticks here. The candlesticks are like basically buried in the back. What was I doing? I was so afraid of losing money that I was searching for any combination of indicators that would help me avoid losing. And so what I was looking for was if I have all of these indicators on the chart and they all line up at the right spot, that's like guaranteed winner. It was almost like I was trying to, sort of find the easy way to make money without losing. I was trying to just find this perfect combination of indicators, and I'll tell you, it doesn't exist. So I had to do the hard work. I had to pay my dues and actually learn how to read candlestick charts. I had to actually learn what these top and bottom reversal candles looked like, how to read level 2. A complicated combination of technical indicators couldn't make up for that. So this is not the way to go. This is not what I want your charts to look like. I would rather see charts that are clean, simple, and easy to read. So if you look at this chart here, STSS, we'll pull the stock back up from today. These are the technical indicators that I have on my chart. I keep it simple. I've got my moving averages, I've got my volume weighted average price, I've got the MACD, and I've got my volume bars. All right, so let's write it down. Let's make a list of these technical indicators that are the must-have, can't live without. So number 1, MAs, moving averages, and I use exponential. So exponential moving averages are faster, they react faster, and I use the 9, the 20, and the 200 EMA. I use them on all time frames. The next indicator I use is volume weighted average price, all time frames. Number 3, I use the MACD, standard settings only on the 1-minute chart. I'm going to talk more about the MACD in a second. Number 4, I use volume bars. So the volume bars show me the buying and the selling, and this is very important. Even if you didn't have candlesticks at all, you just had volume, volume communicates so much about what's happening. Clearly you can see a pop up, a drop down, a pop up, a drop down on this red candle. Selling off, sideways consolidation, low volume, we don't want to be trading it. Then all of a sudden the opening bell and it gives you another ramp higher, another push higher, high volume, then a rejection. So those candlesticks, the volume behind them is so important because that tells a big part of the story. Are there people, how interested in this stock, if it's a stock that you're trading, are people? Are people really excited about this? So number 8 is to use fewer indicators and to keep it really simple. Number 9 is to focus on only trading when the MACD is positive. This for me was a real game changer. So the MACD on the 1-minute has to be positive. If it's not positive, I don't want to trade this. So STSS here at the beginning of the move, where did the MACD go negative? Right here. So from here to here, about here, it was positive, and this was the area I was willing to trade it. This is when the moving averages were still moving up before they started to slope down and before we went into this sideways consolidation. We go back to UPXI, look at any of these days where it's been particularly volatile. Want to be focusing on trading when the MACD is positive. When the MACD goes negative, that's when we get ourselves into trouble. So right here, MACD is positive through here. So right there it goes negative, no trade, no trade, no trade until it goes back to positive, which is right about here. And that gives you that next swing back up. The MACD is one of the most valuable indicators that I use on my charts, but I only use it on the 1 minute time frame. And that's because I'm primarily trading on the 1 minute time frame. So if you're primarily using the 5 minute, then by all means, you can use it on the 5 minute. But if you're primarily trading on the 1 minute chart, then use the MACD on the 1 minute chart. And when the MACD is negative, right here, you can see it's negative on the histogram, I do not want to take a trade. So just trade when the MACD is positive. And number 10, what story is the volume telling us? This is so important. The volume tells us a story. So again, tying back to these indicators. So if we look at the indicator, we'll look at the volume here. In total, big picture, what is the volume telling us? Do we have more buying and more selling? Generally, we have more buying. There are a couple high volume selling candles, a couple, but it's generally pretty strong to the buy side. That's what we like to see. We could look at, and this is a thing, you could look at any chart and you look at the volume and you say, what story is it telling me? That's so important. So let's look here, zoom this in, right again, oops, sorry, adjust it. So in total, is there more buying or is there more selling? On this one, the selling volume candles, the red candles are higher. So that to me is bearish. And it's bearish right there as well. Yes, it rallied back up right there, but to me, this is a more mixed chart. And the results of this chart and the price action is that it was fairly choppy. It was not easy to trade. You can see it popped up, it dropped back down. That's not really what we love to see. Okay, so this is a little pop quiz for you. But what you can see here is the price rallies up. What's the volume telling you? Nice buying volume. One red candle, the next red candle, the selling volume is so light. So people stop selling. So is this a place that I want to be a buyer? And the answer is yes. I want to buy that first candle to make a new high right there. That's our candle over candle pattern and looking for that squeeze back up. How about another pop quiz right here? All right, so we've got this nice rally up here. Look at all this buying volume. You get a pullback candle here. Now, is this a candle where we should be selling and we're done and we're out? Well, certainly if you were in from up here, yes, I would have gotten out there. Yes, absolutely, it's a red candle, but it ends up doing a bottoming tail, which means by the time the candle closed, although it looked weak, it rallied back up off the low. So if the first candle here makes a new high, am I a buyer? MACD is positive, the volume profile is good. The answer is yes, absolutely, every time I see that pattern. What about this one? What's the volume profile? High volume buying, light volume selling, MACD is positive. Do we buy the first candle, make a new high? Absolutely. There you go. Here's this one. What do we do? Nice squeeze up, a little bit more selling, a little bit of consolidation. I take the trade, MACD is positive, but maybe a little more cautious just because those early selling volume candles. You just don't know why there's someone selling that early. So now that you've learned these 10 tricks, you can implement them in your own trading starting today. I encourage you to make sure you download those PDF resources that way you can print out examples of these perfect chart patterns, have them next to you around your monitor so when you see it happening in real time, you've got more confidence and conviction to take those trades. But the learning doesn't have to stop here. I'm gonna put a link to a couple more episodes that I think you guys will enjoy. One that walks you through my most profitable candlestick chart patterns and a couple full-length trainings on how to start trading. Reminder as always, my results aren't typical. Trading is risky, so please practice these new strategies you're learning in a safe and simulated environment. If you enjoyed this episode, I hope you hit the thumbs up, subscribe to the channel, and I'll see you for the next one real soon.